Hey folks, CA Rachana Ranade here, and I welcome you all to one of the most demanded video topics, which is SIF or Specialized Investment Funds. Well, this is a category or an investment avenue, I must say, which was launched by SEBI in February 2025. This is mainly offered to whom? To high net worth folks like you who want to invest their money in something more rather than a plain vanilla equity mutual fund or something like that. Okay, so today we are going to discuss a lot about SIF. First, we'll start with basics of SIF, then we'll talk about different investment strategies which are used in SIF. We'll talk about the difference between SIF and PMS. We'll discuss the difference between SIF and mutual funds, and extremely important, whether you should invest in SIFs or not. Now, first and foremost, let's understand why this SIF was actually brought into existence. And for that, we'll take a very simple example. Let's say we have Mr. Suresh who earns, let's say, 25,000 rupees per month and who is okay investing 500 rupees in an SIP every month. Okay. We have Mr. Ramesh who is a rich businessman and who is like, okay, I earn in crores, so I don't mind giving some PMS to manage my money. And for him, writing a check of 50 lakh rupees, which is the bare minimum amount which you have to give to a PMS to manage your money, for him, that's not a big deal. But then you can imagine there's Mr. Mahesh who is somewhere in between. He says, I can definitely invest way more than 500 a month, but I just can't write a check for 50 lakh rupees just like that. Let's say he has some 10 lakh rupees, 15 lakh rupees surplus with him, which he would want to invest. Now, currently, he's left with only one choice: do a lump sum in mutual fund. Now, instead of that, can there be a different category? And that gap was actually bridged by this new investment avenue, which is called as SIF. Now, okay, we understood what is this or why this investment avenue exists. Second thing we need to understand as to who can come up with this SIF. Who can actually offer this? It can be offered only by mutual fund houses who have the mutual fund license for a specific number of years. In simple words, let's say tomorrow if I say CARR, this SIF, that's not allowed. Even PMS, which doesn't have a mutual fund license, they are also not allowed to float an SIF. Simple tell you, yes. Now third, okay, SIF, some mutual fund started. Okay, I'm sure you might be knowing this. This is just an example, not a tip. Quant Mutual Fund recently came up with SIF, correct? Now, if someone were to invest in this, maybe that person could have gotten an exposure mainly to equity, little bit to debt, little bit to REITs as an example. But then you might be like, okay, investing in equity, debt, REIT, this is as good as investing in some mutual fund only, na? Then what is so different about SIF? The biggest differentiator, very important, biggest differentiator is that in an SIF, the person who's going to manage the money can take unhedged short positions. So if the person feels that market will go sideways for a long period of time, if he feels that market can go in a bearish trend, that fund manager can take short positions which are unhedged. I'm sure dimag ki ghanti baji. What if this fund manager takes extreme risks, takes extreme short positions, invests a lot of money in a single stock, in a single REIT? Is there someone who is going to lay down the do's and don'ts for this? SEBI. Naam to suna hoga. Okay, I got into Rahul Naam to suna hoga. Anyways, so now we have to understand what all are the strict rules and regulations that SEBI has put for SIF. So first things first, they have very clearly mentioned that anyone who's going to manage the funds in the SIF, it's extremely important that they follow certain norms. What are these? For equities, investment in a single company stock that will be capped at 10% of the total assets. Okay, so whatever money they have collected, out of that, let's say 100, as an example, let's take 100 rupees. Okay, I know that it will be, I mean, bare minimum investment amount is 10 lakh, but just for you to understand, okay, if 100 rupees is the total, maximum 10 rupees can be put in a single stock. Simple till here, yes. Single company stock. Second one is exposure to REITs and InvITs is limited to 20% of the total portfolio. So for REITs and InvITs put together, maximum 20% of the total portfolio, with no more than 10% allocated to any single issuer of these instruments. So I'm sure you might have read about, let's say, Mindspace REITs or some other InvITs. For a single issuer, let's say Mindspace REITs, you can't invest more than 10% of the total portfolio into Mindspace REITs. Okay, again, an example just. So the limits are laid down for a single stock, for a single REIT or InvIT issuer, REIT and InvITs together as a category. Okay. One more important point that they have very clearly mentioned, that when it is about unhedged derivative positions, maximum position that they can take is 25% of the total portfolio size. Okay, so again, can a person say whatever money I've collected, 100% I'm going to do a short sale? That is not allowed. Okay, maximum 25% unhedged derivative positions. And for doing all these things, is SIF going to charge something to the investor? The answer is yes. How will they charge? As a fixed fee? No. It's charged very similar to a mutual fund by an expense ratio. So if you want to have a look at the screen, you can see that expense ratio very clearly in a tabular form. Again, this has been guided by SEBI, that whenever the fund size will be smaller comparatively, in that case, the expense ratio maximum could be 2.25%. Okay, but as and how the fund keeps on increasing, AUM keeps on increasing, then ultimately your expense ratio, I mean the SIF's expense ratio could come down, minimum up to 1.05%. It can't go below 1.05%. Okay, that will be the bare minimum, right? All these whatever points I'm telling you, it is as on date as I shoot the video. If the regulatory norms change, of course these percentages may also change. Now let's move ahead with the three different strategies, investment strategies that the fund manager can go ahead with. The three categories are equity long short, debt long short, or active asset allocator. Now, I think the names are kind of self-explanatory, wherein the first one, equity long short, the fund manager will bet mainly on equities, both on long side and on short side. For debt, primarily it will be fixed income instruments, both long side, short side. And third one is active asset allocator. Here the fund manager can dynamically shift between what? Equity, debt, REITs, InvITs, even derivatives. Okay. Now, if you were to ask me which could be two categories out of these, which wherein we can study a bit more, of course, I feel it has to be equity long short and active asset allocator. Logic is very simple. See, I'm talking about this as an asset class, as an asset category for people whose risk taking capacity is a shade higher. They are ready to invest 10 lakh at one shot, 15 lakh at one shot, let's say. Now, for them, returns are going to be important. In that case, why would I park my 10 lakh, 15 lakh rupees in some debt long short strategy? I would not want that personally, I'm saying. Of course, if anyone specifically wants it, his or her own choice. But if I were to anyways park 10 lakh, 15 lakh in debt, I would go ahead with, let's say, corporate bonds, in different corporate bonds, or maybe debt mutual funds also. I would not want to go into that. So we are not going to dig down into the second category. So first, let's understand the very first category, which is equity long short. Now, whenever we are talking about this category, it has three subcategories. Which is the first subcategory? It's equity long short fund. Now, what happens in this? In the equity long short fund, minimum investment in equity and equity related instruments is 80%. So this is pure play. Something like 80%, minimum 80% is in equity. This can be treated like a flexi cap fund. See, I'm just trying to give you mutual fund parallels because you know about them, right? Why am I saying like a flexi cap fund? Because here is just saying minimum 80% in equity and equity related instruments. They are not mentioning how much in small cap, how much in mid cap, how much in large cap. So the fund manager will have that much flexibility to park funds in equity. Okay. Second one is equity X top 100 long short fund. Now, when I'm saying X top 100, X is excluding top 100. What top 100? Top 100 by market cap. Okay. Here, in short, the fund manager is going to invest minimum 65% of the total assets in companies X top 100. Means basically it's going to be mid cap focused. Correct? Because excluding top 100. So, in such a case, this type of equity fund could be like something like a mid cap equity fund, right? And ultimately, the last one is sector rotation long short fund, where it's very clearly given that you can invest in maximum 4 sectors up to 80% of the total money. So this could be more or less like a sectoral fund or a thematic fund per se. Okay, so I hope you have understood the third category as well. But is there anything common in all three subcategories? Answer is yes. The common point is that the fund manager can take up to 25% of unhedged derivative positions. Like I told you, if the fund manager feels that market will go sideways or will go downwards for few more months, that in that case the fund manager can take short positions as well, but maximum up to how much? 25%, right? Now let's move on to the third category. Second, anyways, I told you I'm not going to discuss debt wala, I'm not going to discuss. Third one is active asset allocator. Here, what is going to happen? Two subcategories here. The very first subcategory is active asset allocator long short fund. Now, in this, The fund manager is allowed to invest, be it equity, debt, equity and equity debt derivatives, REITs, InvITs, commodity derivatives, whatever is the case. So this will be, I can say this will be more like a BAF or a balanced advantage fund, where the fund manager will decide whether he wants to park more in equity, if he feels he wants to park in debt or in commodities or whatever. Okay. And the last or the second one here is that it is hybrid long short. Now, what is hybrid long short? Minimum investment in equity related instruments 25%, minimum investment in debt instruments 25%. So I may say this is something like your multi asset allocation fund, where if you remember, in mutual funds, some, I think, minimum 10% in equity, minimum 10% in debt, minimum 10% in commodities, something like that, where minimum 25% in equity instruments and minimum 25% in debt instruments. And of course, here also same condition, maximum up to 25% can be used to take short positions, unhedged positions in derivatives. Now let's understand the difference between mutual funds and SIFs. Some points you already know, so whatever points we have already discussed, I'll go a little bit fast. If I'm talking about minimum investments, mutual fund, you know this, that some mutual funds may offer even investments, SIPs starting from 10 rupees, but generally it will be 100 rupees or 500 rupees. SIFs minimum investment will be 10 lakh rupees per investor. What type of investor would go ahead with mutual funds? It will be generally retail, kind of beginners. It's a mass market product basically. But if I'm talking about SIF, it will be mainly for seasoned investors who are seeking a little bit more return, and for that they are ready to take a little bit more risk as well. If I'm talking about strategies allowed, of course, for mutual fund, it will be mostly long only, buy and hold kind of thing. But if I'm talking about SIFs, it could be long short, it could be derivatives, it could be in REITs, InvITs, whatever, multiple strategies. If I'm talking about unhedged derivative positions, is it allowed in mutual funds? Answer is no. And in SIFs, we have told this, maximum 25% is allowed. Expense ratio will be capped at 2.25% for equity mutual funds, and for SIFs, it is up to 2.25%. I told you, right? We had discussed the whole table also. And ultimately, taxation perspective, be it mutual funds or be it SIFs, it's actually the same. Okay, so no difference here. But if I'm talking about PMS versus SIF, now this becomes interesting. Minimum investment for PMS is 50 lakh. You have to write a check for 50 lakhs, then only you will be allowed to take up a PMS. But if I'm talking about SIF, it is minimum 10 lakh rupees. So is there a ticket difference? Yes. Customization, typically in PMS, it will be fully personalized portfolio. So for example, if I were to take a PMS, I'll write a check for 50 lakhs and I'll tell that I'm interested to invest my money in specific sector, or I believe that these few stocks could perform well. Give me some detailed analysis on that, and we will design something which suits my risk profile, my returns profile, whatever. So it'll be fully personalized portfolio for PMS. For SIS, it'll be more of strategy based. It'll be more of pooled and comparatively less custom. Okay. Who will be the investor type for PMS? Of course, like an ultra HNI category, who are okay giving 50 lakh once a year check like that for investments. And as I told you, for SIS, it will be seasoned investors who are seeking more returns with some extra risk as well. Short selling, as I mentioned, for PMS, for PMS, it is allowed, but it will be manager dependent. And for SIFs, I've told you, maximum up to 25%. Fees will be fixed at 1 to 2% for portfolio management, plus there can be also performance linked fees. So for example, they'll give a hurdle rate that up to 15% will not charge anything specific, but if we cross 15% gain, then any percentage above that we share it, like let's say 20/80, 30/70, whatever is the case. So performance based. And for SIFs, again I told you, expense ratio will be the only fees. For diversification, as I mentioned, it will be client specific, often concentrated. For SIS, it will be pooled, strategy driven. And the last point is extremely important. It is about taxation. Okay, SIS, I've already told you, it is like mutual fund. Here, it will be treated as capital gains even before withdrawal. Now, what is this? For PMS, this is, let's understand with the help of a simple example. Let's say I've put my money in SIFs and it's an equity SIF. Now, what the fund manager does is that, let's say, as an example, he sells Reliance Industries and buys HDFC. Okay, will I have to pay capital gain tax on that? Answer is no, because that's same like a mutual fund. Whenever mutual fund manager also buys and sells equities, I don't have to pay any tax on that unless and until I sell those equity, unless and until I sell the units of mutual funds, I don't have to pay any tax, right? Same case will go ahead with SIFs. But if I'm talking about PMS, assume that there is some fund manager and she is handling my PMS. What does she decide? Again, same thing. sell Reliance and buy, let us say, HDFC. Okay, in this case, assume that I have a capital gain. Will I have to pay capital gain tax on that? Yes, even though I have not withdrawn that money in my account, that money has gotten reinvested in some stock, still I will have to pay tax on that. Okay, so last point, taxation is extremely important. So before you take any decision, generally get to know about all the angles and then take a final decision. Let's move on with the grand finale question as to should you invest in SIFs. I'll tell you one top pro, one top cons, and then we'll take that question, right? We have already discussed a lot though. For me, the biggest pro is that this investment category can really perform well, ideally in bearish or sideways market. For example, right now, since the last 1 year, we have been in a sideways market, right? Nifty has given almost flat or a shade negative return. Ideally, SIFs could have performed better in the last 1 year. Okay, what is the biggest con? There is no track record. There is just one, I think, SIF launched which in this specific year. So I totally understand that whenever we try to analyze a mutual fund, we say past returns are not a guarantee of future returns. But come what may, we do check what is the 1 year return, 3 year return, 5 year return. Why? It gives us a base as to what could be our expectations, right? Similarly, if I were to try and put that here for an SIF, unfortunately, there is no track record. So, would a person want to invest in an investment category where there is no track record? Again, that depends on person to person, right? So, finally, should you invest? If we are talking about a person who is somewhere between that 500 rupees per month versus 50 lakhs rupees one check, somewhere in between, okay, as I told you, has, let's say, 15 lakh, 20 lakh rupees, who is okay giving that as a single investment, who wants better returns as compared to mutual funds, who is ready to take a little bit higher risk. For such people, SIF could be an additional investment option. What did I say? Additional investment option. Why? Should someone sell their mutual fund portfolio and shift to SIF? Ideally, no, they are complementary and they are not substitute to each other. Okay, so they will perform well in different types of markets. And I feel that it would not be a good enough strategy to sell off mutual funds and to park entire in SIF. I also talked about a very important point, which is about tax efficiency. Mutual funds has a very good taxation benefit. So does SIF have a taxation benefit. But if I'm talking about PMS will not have that taxation benefit, but PMS will have the power of customization as per an individual's needs. So I hope you have understood who could this category of investment be suitable for. Tell me if you have invested in the recent SIF or not in the comment section below. Would love to know your thoughts on that. If you ask me, I have not yet invested in SIF. I'm still exploring it. But if you did like today's video, please don't forget to smash the like button. Please don't forget to share this video with your friends. I'll see you in the next one. Till then, take care. Jai Hind and bye-bye. You might have come across such advertisements on various social media platforms. Please note, all of these are fraudsters promising unbelievable returns through stock tips. I don't provide any calls or advisory services. I provide only educational content through my social media handles and through my website rachanaranade.com and rachanaranade.in.